So, Mr. McCarron, thank you for being here today. And if you are ready, now you have the floor.
Well, thank you very much, first for the full introduction and also for the invitation to speak and share today. It's a great honor and privilege to be with you here. Hopefully the slides have come up showing the presentation title. So the topic I've been asked to present on sustainable finance for ESG in Asia. But we're going to focus the talk very much on banks and their approach to climate change. And the reason for that is really because we issued a report last year in March that really looked in quite some detail at leading Asian banks, 32 of them. So that will be sort of the basis and the data that we share from. So just before I get to that, we'll start with introducing Asia Research and Engagement ARE, although that's actually just been done. Then we'll look at some of the findings from the bank report, and then we'll go into a bit more detail. First, to look at decarbonization pathways and some of the very positive news that we've seen in the last 6 months. Then, because of the topic of today, we'll turn to some of the governance aspects. We completely agree that we're not going to get the kinds of business transformation or the kinds of real economic transformation that we all want to see if governance isn't in place. It's absolutely foundational. And finally, we turn to a slightly different topic, this question of greenwash, and some considerations around that, and just a sort of a little taster really on what that means and what it is, and how to address it rather. So these points have already been made. Thank you so much. We work with investors, large institutional investors, to speak to Asian listed companies. We do that across the Asian region. Our headquarters is in Singapore, and we also have a subsidiary in Beijing. And our work on banks is very much part of the energy transition theme. And there's some information about that here. Our objective is not just ours, the investors that we work with as well. There's 8 large global institutions that represent over $5 trillion participate in these engagements. And they are seeking energy transition in line with the Paris Agreement. And we're seeking that by asking banks to go further, think about where the risks are in the portfolio and how to manage and mitigate those risks, and how to find the opportunities to allocate capital to address the mitigation needs, reduction of carbon, and also the adaptation needs. How can banks more skillfully allocate capital to address these challenges that we're finding, and do so profitably? Of course, as investors that we work with, we want to see a profitable transition as much as possible. And then we have a range of different methods, so letters, group meetings, research, and sometimes AGM attendance. We've attended AGMs in 7 different countries across the region, including in mainland China. The report itself, it's freely available to download, and you can find it from our websites. We can certainly ask UNITAR to distribute it if that's appropriate. It looks at 4 different topics. Many of you may be familiar or have heard of TCFD. We're pretty aligned with the TCFD approach, but we slightly specialized it for banks. So we look at governance, risk management, policy, and opportunities, which, as mentioned, we do want to see banks going for those opportunities and reallocating capital. And for each topic, we set out why it's important. What do we see in the region? What investors expect of banks, what the recommendations are, and finally, we put good practice examples, and we try as much as possible for the Asian region to use Asian examples. Sometimes, we see, yes, the European banks, for example, or European companies, they've been doing this for quite some time, but we're now starting to find that actually there's some Asian banks or even some Asian companies that are starting to take a lead. And we think that that's a really powerful and important message for everybody in the region. This can be Asia for Asia. There's no reason that Asia can't take a lead on many of these themes. just before we go into findings, I wanted to set a slightly higher level context, which has already been shared in the introductory remarks. And that's about the national net zero targets that we now have across most of Asia. So as somebody who I've spent over a decade in the region, having these conversations with companies, with financial institutions, and it used to be much more challenging to say, climate change is an issue, it needs to be taken seriously, there is a business case. And that has switched very sharply in the last year or two, as we've seen Asia come out with national commitments. And so Asian governments and nations are, quite often more top-down and more centrally planned economies. And so the signaling effect from these commitments is quite powerful. And also the timelines, everybody understands what it means when you have net zero, that the CO2 curve goes through zero. We understand that. Maybe we don't understand fully what the net means, that word, but we understand intuitively. So we know if you have a high carbon, long duration asset, like a coal power plant, or there's many, steel, cement, we know that the competitive position is going to change. And the timescales for those assets, several decades, although 2050, 2060, they look like a long time away. If we're thinking about a new coal plant, gas plant, steel, cement, those timelines are very relevant. So what those timelines do change what we should be financing today. So since those have come in, it's been much easier to address and argue for the relevance of climate change mitigation measures. So then what do we see from bank behaviors? Now, this data is from last year, March last year. There have been some changes, but the picture is broadly the same, although there have been some changes. And what we did was we looked at bank policies for high carbon emitting long duration asset sectors. And here are all of the banks, top 3 or 4, in China's case, we did a few extra by different markets. No new coal phase out, gas, mining, oil and gas, cement, steel. And we also looked at palm oil. It's very relevant in Southeast Asia, where I'm presenting from. Now, what this shows, if it's green, this is quite good. This is, broadly speaking, what we need to align with the Paris Agreement. If it's yellow, there is some policy, but not what we need for the Paris Agreement, just some policy. And if it's white, well, we don't see any policy. Now, policies should come out first. Many times we see the policy, and then the policy says, in a few years, we will stop financing new coal, or we will phase out of coal. So we expect that the policy states what will happen in the future. So these policies should be leading indicators of the financing activities and the financial flows by the banks. And that means that this picture that we see here, it's currently inconsistent, very inconsistent with these national targets. And because the assets in these industries are going to be around for several decades, this whole chart needs to go green in the next few years if we are going to meet the challenge that Asian governments have laid down. So that's the policy. But okay, how do we get to policy? Should banks just be changing their policies? Actually, it's not so simple. Of course, if you're the board of a bank, you need to think through, well, do we really believe this? How is this going to work? Do we have the systems in place to make this work? Are our clients able to transition? What are the right timelines? There's so many questions. So there's a range of different areas that the investors expect to see. We don't expect an immediate jump to policy. We expect to see progress on multiple fronts. And that's why we set out these different categories: governance, risk management, the policy layer here, and then also opportunities, right? We want the transformation of the balance sheet from the dirty industries to the clean industries. And there's some good news. So across Asia, particularly the developed markets, we see that there has been some progress. There's a start, but it's uneven. Developed Asia is a little bit further ahead, but there are some issues. So if we look at the Asia average, we see green on the opportunity. Now we're going to come to this later. This also lots on the opportunity side, and yet the policies, the governance, and the risk management not in place. That's where this greenwash concern comes from, and that's why we'll come back to it later. And regionally, we see, as mentioned, the developed markets. We put them over here. Of course, we expect them to be moving further and faster. Some positive news in Malaysia. That's very much supported by the efforts from CIMB, actually. So this is sort of, this slide here shows a kind of a heat map of where we are, and it is evolving all the time. Let's dive in a little further. So another way of thinking about this. Now, again, this is data from March 2022. So we see progress. We've just kind of put here, these are where the net zero timelines are. And then on the right, we can see what proportion of banks per market have a net zero for financed emissions target across the whole bank. So again, Japanese banks even last year had those. Korean banks, I think there's been an improvement here. Singaporean banks, actually there has been an improvement over the last year. All three of the largest Singaporean banks now have net zero targets. The challenge is it's not just about the long-term target. We need to understand the path towards that. What are the decarbonization pathways? So what might they look like? And the really good news is that we're starting to see Asian banks stepping up and presenting those. So we've seen decarbonization pathways at the sector level from DBS and from UOB, both in the last 6 months. So these are DBS's pathways. And we can see here how, for the power sector, what they're saying is right. For the financed emissions in the power sector, we want we can see there's they use what are called scenarios. So the IEA has said, what does this sector's future emissions need to look like? And that's the orange line. And then DBS has said, okay, what should our financed emissions look like? And that's the dotted line that we see there. And then DBS has put where they are today. And they've charted that out as targets across all of these different industries. So steel, oil and gas and power were industries that we picked out in our research. In DBS's case, they've also set that out for automotive. There's various different ways that these targets can be framed. So in automotive, are we looking at just the factory emissions, or are we looking at the type of automotive cars that are being produced? Are we looking at the numbers of electric vehicles versus the numbers of conventional engines? This kind of thing. And of course, there's different questions about the choices of the scenarios for each sector. So really, we do need to recognize that there's a lot of work that banks have to do to be able to understand these pathways in depth across multiple industries. Here we go, aviation as well. Everybody knows, I'm sure many of the people on the call have started flying again post-COVID. I've just started doing so. But of course, at the same time, we know that aviation's very high CO2 emitting. So how are we going to see this industry with huge energy density? How are we going to see that transition? Well, DBS has borrowed the IATA net zero pathway and said that's what our target is. That's what we need to see. They've taken different approaches in real estate and shipping. Rather than looking at the overall industry, they're wanting to understand the relative asset performance for the businesses they lend to. And then finally, they've got some differently structured targets for food and agri and for chemicals. And I guess this kind of really does highlight the challenge that remains. We don't have a performance target for food and agri here. It's just a disclosure target. So even DBS, a large bank, is finding it challenging to get solid data from its clients, and it just has a target for disclosure improvement. Actually, as Asia Research and Engagement, we're working with our investors. It's in our protein program rather than our banking program, where we actually are setting out what we believe performance standards should be for the food sector, particularly for protein, available from our website. For any of you that are interested in protein or meat and seafood supply or food supply and want a little bit more than just disclosure asks, then very happy to either reach out or please do check our website. It's available for download. And DBS similarly found too much complexity today in the chemicals sector. So again, they were looking for disclosure rather than necessarily performance targets for that industry. This does represent solid progress. But of course, we need to see the industry's transition. Otherwise, DBS will find it very hard for its own portfolios to transition. And we need to remember these are targets, and it's the financial flows that are going to be the real test in due course. Before looking at governance in more detail, I just wanted to come back and look at some of the nuances relating to policy and some of the different complexities. And that's important because when we come to greenwashing, which we'll do a little later, there's what we might call intentional greenwashing. And then there's sort of unintentional greenwashing. And unintentional greenwashing can happen where, people are trying sincerely to find a solution, but actually the issues are quite complicated and they don't understand them at enough depth. And so they kind of make a mistake. And so I thought it was worth just setting out a little, how we view the different strands of policy taking an industry, coal power. We know coal power has to stop. The timelines are very clear, 2030 for developed markets, 2040 for non-developed markets. So and stop means actual phase out of coal. So India and China, of course, they've not fully signed up to those timelines. That they're slightly aggressive from the perspectives of those markets, but directionally we know what's required, and we know what the scenarios say, and 2030 and 2040 are the appropriate timelines. So what should a policy cover? And first of all, we've got no new coal. And this isn't anymore. This is no longer a doing the right thing question. This is also a very important financial question. If you spend $1 on new coal today, then people don't want to pay $1 for it. So it's very hard to sell. If you're a company and you want to sell coal plants, it's very, very hard. We saw a situation in Singapore quite recently where one of the power utilities wanted to sell some coal plants in India, and they couldn't. They found it very, very hard to sell them. They couldn't get a good price at all. So spending money on new coal plants, you may find it very hard to get that money back. But even still, there's the question. So we understand that in project finance terms, but what about corporate finance? What about if we're lending money to a company and that company is building new coal plants somewhere? So the bank doesn't have the direct exposure, but it could have indirect. It could have exposure to a company that's adding. And then thirdly, there's the underwritings. So, if they've got a client, if the bank's got a client and the client wants to raise debt, and then the bank takes fees for that, but really doesn't retain the financial exposure over a prolonged period of time, the policies should apply to the underwriting as well. That's no new, which is quite simple. And then this phase out question. So again, project finance, it's easy to understand, but corporate finance, what if you're lending money to a company which has got a coal plant and they don't know when they're going to be retiring all of that coal? How should the bank be speaking with that client? So it is quite nuanced. And then, of course, on this particular slide, we then highlight that while coal should be relatively simpler because we know the direction, gas is a bit more complicated, especially because of the fluctuations in the gas price over the last year or so. So we do need to understand that greenwash is happening. Some of it's frankly disingenuous or even fraudulent, but we also need to understand that some of the greenwashing is that actually there is some complexity, and you know, we may need to be a little understanding that it does take time to move up the learning curve. Still, the best defense is governance. And in our assessments of the banks, the 32 banks across the region, one of the things that we looked for is whether there's a sustainability oversight at the board level of the bank. And we found that there were a range of different approaches that the banks were taking. So the worst case scenario was no clear mention of board governance for sustainability or climate change at all. So, you know, maybe the head in the sand approach, we can call it. The next is that the board has oversight overall without identifying a specific party. And in much of Asia, that's in most jurisdictions in the world, not just Asia, that's kind of correct. The board does have overall oversight, but we do find that if you identify a specific party, that accountability makes it, the accountability in the named individuals, then they know it's their responsibility. They know they need to focus on these issues. They know that they may need to challenge the board on these questions. And that seems to create a better context for board level discussions. Sometimes oversight is by executive directors. Positive, but doesn't create necessarily the strategic challenge. Sometimes board committees have sustainability amongst other duties. Of course, this is the biggest, and very commonly the risk committee. So they think, okay, it's ESG, it's an ESG, it's part of risk. And they, you know, they analyze ESG related risks alongside other risks. This is a very good thing, it's appropriate. But what about all of the sustainable finance and all of the new product innovation? That doesn't naturally report through a risk committee. So again, we found that if bank boards want to understand both the capital allocation opportunity and all of the different sort of ESG aspects and how this could become a reputational consideration for the bank itself, that the best banks actually did set up their own dedicated board committees for sustainability. This number, 22% last year, it's increased a little bit more. You know, so from the investor perspective, the investors don't insist on this, but we do see from a practical perspective that this has been the best way to structure boards. And right here, we thought it would be nice just to share one example, particularly for an ASEAN bank, because many of the delegates here today are from ASEAN. So CIMB very clearly sets out the different committee structures that it has to ensure that sustainability is well considered at the board level. And indeed, they were the first Malaysian bank to have a net zero target, and they're starting the process of setting out their decarbonisation targets and interim pathways. If this approach isn't taken from the investor perspective, what the investors do look for is that the bank boards should have access to climate expertise. And this comment, by the way, it's not just about banks, actually. If you think of any industry sector which is undergoing a kind of transformation, then there needs to be expertise on climate change at the most senior levels. Otherwise, how can the board fulfill its duty of you know, reviewing the strategic plans that management is developing and asking appropriate questions to support better developed strategy? So what we looked for was whether climate change was considered in board nomination processes specifically, and we didn't find that for any of the banks. But We did see that many of the banks had board training on climate change related activities. And we also saw that in many cases, even if they didn't officially state that climate change was a relevant experience point, they still had a director with relevant expertise on sustainability or climate change more specifically. So, you know, they might be doing this in practice, even if they don't have the appropriate process at the current point in time. And we think that, you know, this, whether it's through training or whether it's through appointing experienced individuals, we would expect this to continue and to strengthen as more and more industries start to really try to integrate climate change considerations into their strategy. Risk. So risk really kind of cascades a little bit down from governance, but it's also very much the subject matter of governance. And this is one thing that we really we really do think is sort of an overall issue, and it's one that we see in many companies, but it's something that we had the data to highlight here for banks. And what we're looking at is that on the left, you see by the different markets, how many of the banks are identifying climate risks in their financing. And, oh, okay, it's 2/3, right? So at least 2/3 of the Asian banks last year were acknowledging, yep, climate risk, we need to think about that, whether it's transition or whether it's physical. But that could be somewhere in the sustainability reporting. We're very general about where we were looking for that kind of acknowledgement. What about when we look at the risk register? Now, the risk register is an important document because it's more likely to be regulated in many different markets, and it sets out specifically the risk function of the organization. What are the different considerations that the risk function needs to focus on? And what we found is that while the banks are identifying climate risks in their broader reporting, those climate risks are not necessarily identified in the risk register specifically. So then there becomes a question of, well, how seriously are those risks taken? What's the allocation of resources, systems, and processes to support the transformation in the banks that are going to be required? So that's why we put this slide there. But this isn't just a topic on banks or investment. It's a broader question as well. Certainly something to think about for any of you working in finance, advising finance, or thinking, or even thinking in broader institutions. Finance functions in public sector even as well, might want to consider that in risk planning processes. So I was asked to comment a little on greenwashing a little bit more directly. And so let's see. So the first point when we look at financing is like, fantastic. We want sustainable finance. We want to see banks allocating capital to the solutions sectors. In fact, what would be ideal is that the ideal world would be one in which green finance was the norm and brown finance had a penalty. Of course, or brown or black finance had a penalty. Of course, we're not in that world. So what we find at the moment is that a lot of the banks, they're putting out their targets for sustainable finance, and I'll talk a little bit about it's a busy slide this, about the different components of that in a moment. And actually, it's kind of quite costly because there's a lot more scrutiny that's attached to the green and sustainable finance. And we want it to be low cost, and we want it to be efficient, but actually it takes more work to do it, which is a challenge for this whole enterprise of sustainable financing. Nevertheless, it's been very positive to see that there are these targets. Most of the time when they put out targets, so just as MUFG, they've got a cumulative target from 2019 to 2030 of 303 US billion, or they did it March last year. So we want to see all of these. From an analytical perspective, there's a few considerations that we need to think about. One is that the targets often, if they're cumulative targets across a range of times, we can't compare that to the size of the company as it is today, or the size of the balance sheet today, because we don't know when that's going to be filled up. And then secondly, particularly for banks that they've got their corporate lending business, the retail business, the asset management business, the insurance business, maybe they're universal banks, and then they've got all of those different product types. The way that you do ESG or sustainable finance is very different in those different areas. So when they add it up and put it in one target, it's very hard to understand what that really means and what we're really going to see from the different businesses going forward. Actually, I don't have it up here, but KB Bank in South Korea is quite good at that. Very detailed description of how they're doing across all of their different business units. Quite good to see. So anyway, good that we're seeing this, but we do need to see some kind of consistency in the way that it's described. And secondly, we also need to understand, are these targets big enough to supply the capital that the society is going to need to transition in each of these different countries? So at the moment, that question is not really answered. The targets are, they are set, they're not really kind of set in a very structured fashion, or they haven't typically been historically, and they're not set with respect to the needs that society has at this stage. And then, of course, there's this other question of greenwashing, and I'm not going to give named examples of different deals. There are some that are out there, but I do want to talk through a number of the different types of greenwashing that we see, just so that you're kind of sensitive to what not to do, really. So one thing that we sometimes see is called green crowding. And here, a lot of companies come together and they, because there's a large group of companies that are all trying to work on something together, what then happens is that they all sort of say, well, they feel that they're protected by the crowd, and unfortunately then start moving at the pace of the slowest member of the group. And that can even sometimes hold back the leaders. And we can't sometimes see this kind of issue happening in plastics, for example, which is a shame. Sometimes companies may be able to move forward and faster. Or else another challenge and consideration, green lighting. And here is where an organization talks a lot about a very small issue and doesn't talk about some of the bigger picture. So in the banks, we hear a lot about some of the deals, but of course the banks are maybe also financing fossil fuels quite a lot. And maybe today it's appropriate that they're still financing fossil fuels. We need fossil fuels, we can't switch them off right now. But when the bank talks so much about the green credential and doesn't mention where they are today, then that creates a disconnect. And in fact, in the UK, there was a complaint about HSBC to the Advertising Standards Agency in the UK. And it was resolved. It was found last year that, in fact, HSBC had misled the public by making claims around climate change without really explaining that actually it still has a lot of fossil fuel financing. So this can become a regulatory consideration. Another one is green shifting. And here, particularly for fossil fuel companies with a large footprint, they say, well, it's not our fault. We can't change because the consumers are demanding this product. The consumers need to change. So it's sort of a little bit finger pointing somewhere else, really. At the end of the day, we need societies to change, and those who are in charge of the production processes, those behaviors need to change. It is quite simple. So beware of that. Green labeling. It's a little similar to green lighting, but maybe more of the product. So we know so many products. You go to the supermarket and it says, there's something that it said. I think actually when we buy animal products, we see this very much. Free range chicken or something, and then they have a wonderful picture of a chicken out in nature, and of course the chicken has never seen nature, or something like that. So that's a very common one, but there's many different contexts like that, where then there's some kind of labeling or marketing word that perhaps doesn't have precise meaning. The best tend to have certification systems that back up the claim and demonstrate the credentials. And then there's green rinsing, and that's where we see frequent changes in the performance targets that are being used. So the example of this that came to my attention recently was some of the US, the soft drinks manufacturers in the US, their targets on recycling rates they change the targets every couple of years, so you can't really tell how they're performing across time. Now, sometimes there's good reasons for targets to change as you understand and you become more sophisticated. But generally speaking, if the target and the baselines change, then it's hard to trust the company through time. And then finally, we have kind of almost the opposite of greenwashing, and this is called green hushing. And here there's what we call underreporting of or hiding of positive credentials. Actually, this is a problem. So very often, when we think of NGOs and how they, or the media and journalists and how they'll pick on companies, very often the companies with a good brand name get picked on. Sometimes the companies with a good brand name are actually doing a good job. And so, but they still get picked on because people want to read about them. And so the temptation can be, well, look, if we're going to be criticized for what we say, no matter what we say, maybe it's better to say less. And that's what happens in green hushing. So that's a shame, because sometimes it's that transparency around the progress that is being made that inspires the rest of the industry. But still, we have to understand sometimes companies are going to take that kind of decision, and sometimes we need to be really rewarding and very positive about efforts that are being made in challenging markets. Still, when we look at the broader social context and we look at how society hasn't made all that much progress yet on climate change, but perhaps we do still need to have that strong assertive voice that, yeah, we really need this. So for those of you who are, we set out a kind of a little prescriptive template here, and we borrowed these from, it was a Forbes article about someone, Desiree Fixler, who used to work at DWS, and highlighted some challenges in their disclosure. So these are framed around investment, but they can all be sort of reinterpreted at whatever your industry is. So have clear criteria about what is meant by an ESG product. So that's particularly true for an investment product, but it could be true for, if you're selling or marketing anything, from the supermarket, or a car, right? Electric vehicle, whatever it is, what is an ESG product? When you're selecting, data and putting the, make sure that the data supply, you can trust it, it's credible. Think through how you aggregate the data. So, I mean, these are very much more in the investment mindset. So have an integrated process for constructing ESG products. Which are the company, what does ESG mean for you, and what different features of companies can go in our portfolio. And then number 5, I think 5 is, very much just a values question at the end of the day, because ESG is complicated, because there's things that need to be considered. If you have prescriptive rules, it can be hard to apply them. So managers may need to focus more on values. What is integrity for us? How do we ensure that we're actually authentic to our brand and to our purpose? And maybe authenticity and values and integrity and those appeals will support your organization in the change journey that it needs more strongly than prescriptive rules. That's certainly something to think about. Identifying and managing conflicts. Again, I mean, any change journey has this, never mind just a sustainability journey. And in sustainability and ESG, there's usually more trade-offs are baked in to the effort. Very often the E and the S, there can be concerns about conflicts. There may not be conflicts, but concerns. So identifying those, considering how they can be resolved at the opening. And then finally, this real point on governance and ensuring that the governance and the intentions from senior leadership are reflected all the way down to the bottom, and also at the bottom, for organizations more bottom up, that there is the ability for the people who are developing products, the people who are interfacing with customers, to sort of have any concerns that they come across reflected and raised up to the higher parts of the organization to ensure that there's proper management all the way through. So I'm not going to go into the appendix now. Very, very happy to share any other thoughts. If you're interested, welcome you writing to us or liaising with UNITAR to get in touch to share the report. And very happy to take any questions on the panel later. Thank you. Thank you ever so much.